Right, good morning everyone. Thank you to Rich and the COEO team for inviting me back again this year. Thank you, that's right. For this year's Customer Focus Summit. So I'm here to talk about some of the sort of potential headwinds the UK economy has been going through and how customers seem to be responding as we go into 2026. So for that, I've kind of put the presentation in three parts. So the first part, we'll do a macroeconomic view of what we're seeing, some of the challenges, and then how we think customers are responding. And there's a few interesting little trends that are starting to appear that we'll try and pick up on. We're then also going to have a look at new data. That's the world that I'm in now. What new data's out there, and can it drive better customer experience? And if so, how? There's also the so what element of that, so we'll talk about that. And then I thought I'd finish off by just going, that's great, but also make sure you get the basics right. There are some core basics within the data that my team have been looking at that I want to make sure people are just aware of and you're sort of following the correct processes. So that's where we're going to go for the course of the presentation today. I think one of the interesting things about standing here on this stage a couple of years since I was last here, please move, there we go, is there's a bit of an element of Groundhog Day when you look at some of the stats that are going on. So sort of what, 3 years ago, we were here and you know, we were sort of coming out the back of COVID, then there was a war in Ukraine and inflation had been high and cost of living. And then going into sort of 2 years ago, the economy had shrunk a little bit, there were some challenges, inflation was coming down, and sort of the general question was, you know, the press have this really bad view of life's terrible, is it? And then we had a bit of a look around that. Now, the other big thing about 2 years ago was we were going into an election year. So there was a bit of optimism going to election, things are going to change, new government coming in. We did talk about the fact they were a bit limited by budget constraints. So we talked a little bit about that. And then you can kind of go, okay, so 2 years later, what's happened? Well, it is a bit of a Groundhog Day because the economy is pretty flat. It basically did shrink unexpectedly in Q3. It ended up last year growing by 0.1%. So not really much going on there. Employment's gone up. It's gone up over 1% over the 2 years ago and 0.8% during last year. Now what's interesting is whilst unemployment might have gone up to 5.2%, the employment rate has actually stayed static. So the employees are still at just about 75%. And that's partly sort of a growing population, but we are seeing an increase in unemployment, and which is quite sort of interesting, the implications that has. You've got a bit of a sluggish economy, the market has sort of just softened a little bit for employees, so it's a bit harder to actually go and get work, and potentially meaningful work as well. That's the other key thing at the moment. Consumer confidence is still not brilliant. Now, again, a couple of years ago, it was actually increased by 2 points, but it was at minus 22. It's now at minus 17, but it's still increased by 2 points. It's got better. So people are feeling a little bit better, but it's still at negative 17. So not ideal. Inflation has come down a bit. So inflation is now sort of running at 3.2%. It has dropped a bit. It's stabilized. That's quite handy. But of course, some of the factors that we're now faced with, you know, just over the past week, there's been a war kicking off in the Middle East. That's going to have implications on inflation. Are we going to see a spike? And if we do, what does that actually mean? That's something that's out of control of the government. That's not a local factor. That's a global factor which can impact us. Interest rates coming down a bit, which is quite nice, 3.75, so they've dropped again, so that's quite encouraging. And with all of that, with a flat economy, not a struggling labour market, but a softening labour market, inflation coming down a bit, interest rates holding. The one thing that just seems to keep going and keep on giving is house prices in the UK. House prices just keep going up, okay? Yes, they've softened how much they're going up, but they still keep going up, which is really interesting when you look at the market and sort of the potential from the Renters' Rights Bill, the impact that had in getting more houses onto the market. Still seeing an increase, it's still going up. So, and that again, sort of some of the challenges. So, just before I got here, actually, one of my colleagues in my team sort of just messaged me. She'd been listening to an AI conversation and was saying, "Oh, it's so depressing for youngsters at the moment. They're going into a world AI is taking their jobs. There's less jobs out there. There's too many graduates. House prices are going up." And it was a bit doom and gloom, but it's not all that bad because jobs are still there. It's just sort of trying to sort of find them all out, I suppose, is one of the key things. So there you go. I think point that way. This was a general piece we picked up on one of our decks that we sort of put together. And again, it just frames a few bits of where the economy is starting to go. So on the far side, we talk about consumer finance growth. So there is growth consistently in the world of consumer finance at the moment. We've seen credit card debt going up. We've seen unsecured loans going up. So from their point of view, they're kind of going, yeah, new business is 5% higher. Great, but people are borrowing more money. Okay, so yes, might be slight lack of confidence, but they're still borrowing more money. But then at the same time, this bit in the middle, sort of, again, a tiny bit depressing. Just going, people go, oh yeah, we're spending less on Christmas now. You know, they've reduced it by sort of the average of 200 quid. And the amount of people that say they're going to spend £1,000 has dropped to 15%. Still quite high. That's quite a lot to spend at Christmas, really. But it's still come down. And then this one, I particularly like this one because you've got a house on fire when it talks about energy, which is kind of about right, really. And this is such an interesting area if you follow anything to do with energy costs, because only about 3 weeks ago, it was announced energy bills are going down in April. There's been a change. Everyone's going down by about 115 quid a year. Happy days. Yesterday, come August, it's going up by 150 quid. The war's going to impact it. Inflation's going up. Oil's more expensive. Gas is more expensive. So this is such an interesting area because it does fluctuate massively. Government policy is impacting it, but so are global events. And just when you think it's starting to come down, it starts going back up again. So again, when people are feeling what they're thinking, how they look at how much they spend each month, energy is a really big one, sort of just to keep an eye on. And then when you start to look at insolvencies, this is the first area where we can start to see some interesting trends. So this line here I've put on, that was because last time I presented what we could see, what we were talking about a bit of a reduction in overall insolvencies. And what could we see? Now, there's a few interesting bits that sit behind the headlines. So there was a headline just a couple of weeks ago talking about a 30% rise in bankruptcies over last year. Yeah, that's kind of not quite true. If you take it month on month, and yes, from January 2025 to January 2026, factually, it is 30% higher. But that's not the full story, actually. Because when you look at it throughout the course of the year, the back end of the year was lower than the start of the year. It just so happened to be that January 2026 was higher. Now, the other bit to lean into on that is, yes, January is higher. The interesting part is it's also the biggest month since April 2021. So there has been a bit of a change there. The other thing you can see, and perhaps one of the key bits, is last time I presented, I talked about the impact of DROs, that DROs were having, and slightly speculated about the idea that could DROs overtake IVAs as the biggest form of insolvency. Government policy had changed, there was an evolution, could it overtake it? Well, actually, the answer is no. 2 years later, that hasn't happened, because what has happened is IVAs have also increased. This part here. So what you can actually see is during the course of last year, IVAs went up 7%, DROs by 8%. And what that has done, which this is the first little trend you can now see, for the very first time, overall insolvencies are now just creeping back above where they were in that sort of pre-pandemic times. So that's a long time ago, but even so, it's the first time we've seen it raising there, because what sort of happened post-pandemic, you sort of had these trends of it all dropping and easing off, and then just suddenly here now, you can see that since I last presented, there has been a consistent increase there, and particularly driven by IVAs going up and the continual rise of DROs as well. Actual bankruptcies themselves have stayed relatively, in fact, the numbers are low. You're down at about 890 odd now, but that's still significantly higher than it was in sort of 2021 times, so it's heading back up. So that's things to keep an eye on. So insolvency, personal insolvencies are just telling a story of, yeah, there's definitely a bit of stress just starting to come through. In the world of DROs, if you want to be a bit controversial, you can argue they're a bit more attractive. Okay, fine. And you get adverts on the radio telling people to take out IVAs, and people do. So that'll be driving some customer behaviour, particularly on social media, etc. But people don't take this lightly. They don't just sort of go into it for the fun of it. So actually, the implications here is that, yeah, there is a bit of stress just starting to show. And for the first time, we've had a consistent rise, and it's just starting to hit the levels we've seen before. Now, of course, what could happen for the rest of the year is that could sort of flatten off and just stay at that kind of level, which is where it was pre-pandemic. That's what you might call our kind of normal levels. If it carries on spiking up, then that becomes an indicator something else is going on for the first time. We are seeing more insolvency. So that'll be an interesting trend to sort of see which direction that starts to go in. And then when you start to look at the overall economy, I think this little chart here is one of the most telling. That's the performance of the UK economy, which you can kind of go is a bit disappointing. It's a bit, the government came into power. They built a lot of their sort of campaigns and policies around growth. We're going to drive growth in the economy. And it's done that, which is not a lot, to be honest. We even had a shrinkage at one point. So, and even 2 days ago, in the spring budget, they've sort of announced in the statement that actually growth has been downgraded to 1.3%. Now, even when you look at that, 1.3 even seems a tiny bit optimistic, and it was 1.6. So, again, that just shows the economy is ticking along. It is on tick over, but it's not really growing. You know, you've got industry optimism's just relatively low. And part of the reason it's a bit low is because of government policy. You know, it's been viewed as not massively pro-business when you look at some of the rules they sort of brought in. So people aren't investing as much as they could be. They're not employing as many people as they sort of want to necessarily. And from a government side, what they can do is starting to be a tiny bit limited. When you look at some of these figures now with trade deficits and debt to GDPR ratios, they're huge, okay? We have a huge amount of debt in the UK. The one sort of chink of armour that the government does have, if anyone paid attention to it, was in January, there was a massive tax surplus. For the first time, it was a record tax surplus that they actually brought in for the first time. Tax receipts were 46 billion, with a surplus of 30 billion. It was kind of double the highest that they've seen before. So that's one little sort of benefit the government have, and that's given them a little bit to play with because they're about 30% lower on borrowing than where they were last year. We're still borrowing a lot, but it just happens to be lower than we were borrowing last year. So that gives them a tiny bit to play with. And one of the impacts that's had, I don't know how well you can see this, is up here, just before Christmas, we were at a 95.5% debt to GDP ratio. This 1 month has changed it to 92.9. So it's brought it down almost kind of 3%. So it does make a difference, those tax receipts, what they're bringing in to help sort of fund government spending. So how does that impact individuals on a daily basis? Okay, so summary, at a top level, a couple of key things on here when you start to think about this. And are people worried about jobs? Are they concerned where the economy is going? Okay, maybe. But you can still see mortgages, there is momentum in that market. And I'll touch on that in a second because the mortgage market has massively been driven by government policy. And you'll see it on the next slide when we start to go through that. This is a really interesting area. Credit cards, that's growing. That's consistently growing. But arrears aren't, okay? So when you kind of look at that, there's a lot of stability there. So how are people doing that? Borrowing more, but not getting into debt with it, okay? So that's encouraging. That's sort of a good sign as well. We've seen it the same with retail. Again, you can see more people sort of borrowing in that sector. So when you sort of look at this, generally, from what we're seeing in the data, the sentiment of individuals isn't too bad. People don't seem to be worrying massively about what's going on, or they're all over indebted, or they're struggling to pay, because that's not quite what we're seeing. So housing and mortgages is always a fascinating area. In the UK, we love our houses. Everyone wants a house and mortgages. And there's been a few sort of key changes that's happened this year. And one of the most interesting ones is that massive spike here. So this is basically our index view of people applying for mortgages. Okay, so this compares to originally Q1 2022, and anything above 100 is an increase, anything below is a drop off. So again, you can see interest rates, not surprisingly, had a big impact on people applying for mortgages. The market kind of settled a bit, started to grow back to where it was, and then the government announced a change in stamp duty last year. And that policy change drove a massive influx of people trying to buy houses before that happened. So government policy directly impacted people's behaviour. And what we sort of realised, and unfortunately that bottom one's slightly covered, but effectively the two sort of core groups we had a look at is people that were kind of motivating moving into 200 to 400,000 pound houses were trying to save £2.5 grand. Your high-end people were trying to potentially save a lot more. And what we saw was before the policy came in, you had an increase, particularly in this group, of 93% it went up by, which is the red bar there. The orange group was up by 69%. Overall, originations went up 49%. As soon as that rule came in, the following month, so April 2025, you get a drop-off. So down 49%, down 61%, and down 72%. So that did have an implication as people rushed to avoid the stamp duty. So it does show what the government does can impact what people are doing. Now, since then, from that low, it's picked up slowly and is starting to grow again. So people are now again starting to buy houses. Now, it's only a sample of one, but where I live in Lincoln, my wife's a housing officer, so I get quite a good view of what's happening with the market generally. And particularly where we are, what we have seen is due to a big growth in building of student houses, student properties, and the Renters' Rights Bill have combined to mean a lot of those smaller mid-sized houses are starting to come on the market. Okay, and that is driving prices. It's actually driving rent prices down, and it's also bringing more to market, so more people can start going after properties. They aren't massively cheaper, so it hasn't changed the price of them, but it's bringing more into the market, so therefore people can actually start to apply. So people are still actively applying for mortgages. And then when they do, the arrears rates are pretty flat. And this is the kind of thing that you want to see, okay, particularly mortgages. They are flat. Yeah, they've gone up a little bit, but then they've settled down. So you can see it consistently ticks along between sort of 1.3 and 1.5%, and the yellow bar being those people that are one payment in arrears, the red bar, the more serious one, being 3 payment in arrears. Now, when I was here 2 years ago, one of the things that we talked about, and we'd noticed, was when you looked at certain roll rates, the 3 payment down had closed up, basically. And what that actually meant was more people getting further into arrears were struggling to get out of it. What this is starting to show is that gap's widening up again. So there's less people going into further down the arrears cycle, which is good. That's kind of what you want to see. The thing we did notice here that I thought was interesting, particularly when we talk about the Renters' Rights Bill, the impacts, what's happening for landlords, the implications of it for them, when you start to look at second mortgages. Now, we're not seeing a massive spike in arrears on second mortgages. You can see it's ticking along. But it's just interesting when you look at the figures. So you can see, as we've talked about, the average about 1.4, 1.5. Second mortgages, early stage arrears, is still at 7.5 to 8%. So it's basically 5 times higher. So if you have a second property, there is you're 5 times more likely to start missing payments on it, particularly in the current market if you're not renting your property out, if there's an issue with it. So it's kind of an interesting observation. But the key thing is the arrears are relatively flat. So when people are looking at what they're going to pay for, if they're starting to struggle, how do they prioritize their debts? Mortgages are still an absolutely key one that they're going after. And then when you think about this market, bits that are quite interesting on some of the changes. So here you can now see there's been an increase of £256 on the average mortgage. It was 238 last year, so it's gone up again by another 43%. You've now got 298,000 people who are switching into interest only or temporary sort of forbearance on their properties. That's up from 138,000 a year ago. So again, a significant change there. And then this is a really interesting one. So 2 years ago, we first noticed there was a month where about 10% of people in that month were applying for 35-plus year mortgages. That's now gone up to 11% for half a year. So you're now at a point where 11% of all mortgages in half of a year are being applied for over 35 years. And when you consider the average age of somebody applying for a property is 34 years old, that's now taking them basically up to retirement. And that's one thing that's happening. That market's evolving as people apply for longer-term mortgages as they want to start trying to pay it off. And that could have some potential implications sort of further down the line. This is what you could say is kind of one of the success stories of financial services is credit card debt. And again, this is an index view, but it just shows constant growth, and it's comparing it there to weekly earnings, and both are going up together. So as people have earned more, they're also taking more on credit cards and spending more on credit cards as well. So it's an area of consistent growth, and this is fascinating now. We're up to 12.7% above pre-pandemic levels sitting on credit cards at the moment. Last year it was 4.8. It's now at 12.7, so that is growing. So 77 billion that's now owed on it is sitting in that space. Okay, so people are actively using credit cards more and more. This isn't just transactors. This isn't just people that are getting points, basically, on their credit cards, etc. People using all kinds of different cards for different amounts, but spending on it consistently. And as they're earning more, they're spending more on it. And also you can see here from the originations, as people applying for credit cards, it just keeps going up. So again, you look at that 100% mark, that 100 on there, and the line is constantly above it. So we are seeing a constant increase in people applying for credit cards coming through our system. So it's obviously regarded as a key area people want to go after. And then when they have the credit cards, what's going on with them? Well, there are 2 little trends that we keep an eye on here. So again, arrears rates, they're pretty good. Arrears rates are about what we expect them to be. They're staying flat. So as we've seen, basically for 4 years now, there's not massive spikes in arrears. There aren't huge changes, people getting behind. They're all remaining pretty flat. People get into arrears and they recover back out of it, or some of them roll into 3, but the numbers aren't huge. But this is an interesting one just to keep an eye on. Okay, so this is your average payment to balance ratio, and you can see it's dropping. So effectively, they're putting more on the card and paying less of it off. So that's one of the interesting bits to keep an eye on. Is that how people are managing? They're happy to allow more to sit on their credit card. So you can see it was up in the early 40s. It plateaued here at 39 for a while, stuck in that area. And then it's been just tailing off now. So it's just sort of dropping down. So it's just sort of dropped down a little bit. So it's going sub 39, heading towards 38%. Now, again, the percentages aren't massive. We're not talking about 5–10% shifts. You're talking about 1–2% at most. But it's still a downward trend, so it's one to keep an eye on. If people are borrowing more money on credit cards and then paying slightly less off each month, is that deliberate, or is it because actually they're struggling a little bit with affordability? And that is one way to manage your credit as you kind of work through. If you've earned a bit less money, you've got a bit more on your card, okay, we'll pay slightly less off. Or because you want to go on holiday and spend it on something else. Okay, so again, are people's behavior going to impact that long term? And then if so, this is one of the other really interesting questions. Okay, so what's happening in the BNPL sector? So BNPL, as you're probably aware, I'll touch a bit more later on, is becoming more regulated this year, so it's going to become more visible. Okay? However, at the moment, it's still a growing area. Now, if you go back to basics, the BNPL sector, their target was very much the credit card market. They are there to help facilitate shops to sell more goods, get people to buy more, and stop you paying on your credit cards, which charge you loads of interest, and it's old-fashioned, it's old technology. Use BNPL. You get it for interest-free. That's what they're going after. And you can see it's succeeding. It's growing. It is consistently growing. The average spend now that we can see in the transaction data is up to £74. It was at about 63 a year ago. Now it's up to 74. So people are spending and consistently spending. Okay, so the amount of people we can see using it, you're now heading up to a third of the population are using BNPL. And then you start thinking about, okay, if they're using it, what impact's it having on their finances? So first of all, this is the value, the percentage of what they're paying to companies going out of current accounts at the moment. And again, it's basically going up. So they were originally paying around about 5.5% effectively of their monthly spend going out on BNPL repayments. You're now heading up towards kind of the 8% mark. So again, it's a movement. The people are paying more of the money in their current accounts to pay off their BNPLs. And then the other interesting thing is, okay, how does that compare to the credit card market? Because that's their core sector. Okay, that's the bit they're really going after. And you can see here that, yes, it is increasing, but not massively. And of course, the other interesting bit we've just spoken about is we know overall the amount on people's credit cards is also increasing. Now, they might be paying off a tiny bit less of it. So what this is effectively saying is actually here, as an overall percentage, yes, BNPL is eating a little bit into the credit cards, but at the same time, the credit card spend is going up. And what that says, unfortunately, the chair is in the way of it, which is the key text, is the observation that we can draw from that is that people are taking, it's an and statement, they are taking BNPL and credit cards. It is not an or. They're not doing one or the other, they appear to be doing both. So this is becoming a way of life. People are starting to go, yeah, do you know what? I've got my credit card, great. Oh, I can go to BNPL, I want to buy some new shoes, I'll go and buy those. So that's one of the interesting trends that we're starting to see. And this is potentially going to evolve. Okay, and we'll sort of see what happens later in the year when we start talking about the regulation that we'll touch on a little bit later. So what we did do is we had a little bit of a delve into BNPL and the scores that we can see. And this is a really interesting area because one thing we are seeing still, yes, it impacts younger population, but it's also still what you'd regard as non-prime or subprime. Okay, so effectively that's the average score. We can see 560. For your BNPL population, it's 274. So it's almost half. Okay, now we do have a natural view of the subprime bias because of where we get the data from. But even so, within that population, you've still got a big split. And even in the top groups, in the top 25%, it's still split 673 to 379. So it is generally more sort of subprime, younger population that are targeting that area. Elsewhere, unsecured loans, again, there's been a bit of an increase in originations we can see, particularly towards the back end of last year, more people applying for unsecured loans. And there has been a bit of an increase of about 9.9% in the arrears rates. So not massive, but again, a little upward trend. So you start to combine that with they're borrowing more on credit cards, taking out BNPL, borrowing more on unsecured loans, and potentially seeing a small uptick in arrears. So that's one to keep an eye on at the moment. And then, sort of finally, a little bit on auto lending, because we thought this was interesting. This is looking at motor finance. In fact, you've got your captive lot there, so your manufacturers groups. You've got the bank-backed ones there, so Barclays, etc. Because we'd seen a spike in arrears in this sector. And actually, it's the non-bank lenders that did see a massive spike in arrears there, and it's just starting to tail off. And that industry, not only have they faced a bigger spike in arrears, of course, you've now potentially got the whole piece around mis-selling and people claiming money back off them. So they're facing quite an interesting future at the moment, that world. But it does show you the key banks and the captives are keeping their arrears rates very low. It's only really people buying what you might regard as slightly older cars in a slightly different sector where we've seen the increase in arrears. So what does that mean from new data? What are the implications? Can you start to use new data to try and help make better decisions if you've got younger populations, if you've got over-indebted populations? What else can you do? So we work with a partner of ours called ClearScore, and they've built something called DriveScore. Okay, so this is an app that sits on your phone. So you download it, you stick it on your phone, and then whenever you go for a drive, it monitors your behaviour, basically, to then start to go, right, okay, and if you drive better, are you a better risk? Now, what they've looked at is they've kind of run the data, they've run the analysis and gone, yeah, actually, this is really good. Actually, it shows people that drive better are a lower risk. And here's how we can see it split within the score populations. So along the bottom, you've basically got the score bands from our Risk Navigator score, then this is the behaviour, and the bit at the bottom says the average splits is 750 is what they regard as a good score. So you've got better drivers versus worse drivers, and the difference in each band, basically. And effectively, it's starting to say, actually, yeah, if you take a score band and you subsplit it, then it can prove to be more predictive to help you make better decisions to drive better customer experience. That's what it's trying to go after. Okay, fine. Now, this is a massive area that I love in my wheelhouse, okay? Because for me, my big, perhaps it's a real anticlimax now, it's not changing slightly, there you go. My passion in life is motorsport, okay? I love rallying, I compete in rallying, I organise events, I marshal. In this particular car, I'm actually co-driving. I'm not driving, I'm co-driving, okay? Now, people often say to me when they hear this, oh, you must be a right lunatic. No, I don't think I am, actually. I've never had any points, haven't had an accident, which is a dangerous thing to say, I've got to drive home today. But actually, it actually makes you more aware of risk. Because when you are competing, things go wrong. And this is genuinely one of my cars. I was in this car. That's my stuff as I've come out the other side. We hit the tree upside down. So I've been through it. I know what it's like. And therefore, I wouldn't drive like that on the road. You'd be insane to. I've been through 2 very sizable accidents. But part of the reason I came out of it, and unfortunately the text is hidden at the bottom again now, part of the reason I came out of it okay is because it's a regulated sector. We don't just rock up and rag it through a forest. You have rules you follow. You have regulations you stick to. We build the cars, so they have roll cages in. We wear helmets and hands devices. You know, we have what we call the NCRs, the national competition rules, that event organisers follow, that we follow. So we're trying to mitigate that risk. So I have a view that I'm a member of Motorsport UK, I have a licence, and I believe I'm actually quite a good driver. The thing about DriveScore that I found interesting was it's kind of quite emotive. How do you define what is a good driver? Because I've threatened to take the phone out in my car, in the rally car, when we do an event, just to see what it says, because I think it'd be quite interesting. Because can you start to influence it? So if it's your phone, if it's an app that you are controlling, you're into a world of data democratization here. So we as individuals are starting to control that information. It's an app on my phone that I decide where it goes, who I give it to, what is it reading. So you have to take that into account. But actually, it still starts to have a use because it can tell you some interesting stuff. So, for example, in this particular example here, these are generally your auto declines in the world of lending. These are kind of your auto accepts. Now, chances are you're probably going to go, if I've got an auto decline, I'm not that bothered. I don't really want to accept them. But when I've got marginal declines in the middle, can it start to make a difference? If I've got someone here that could be a refer, and at the moment, if they go through a refer process, they go through manual underwriting, and manual underwriting takes time. But actually, with this kind of data, if somebody's sharing it with me, and I've got an AI tool, for example, that can interrogate it and understand it, can I make the experience better? And does it allow me to start offering different products? Does it allow me to take customers with thin credit files and make other decisions? Okay, so this is not your traditional data sets. This is the new world of data on phones, information we're collecting. And the kind of world that starts to get into is, what else could we start to think about? We touched on mortgages, 35-year terms, getting longer and longer. Okay, well, one thing nowadays that happened sort of 10 years ago was, as PAYE employees, you get enrolled into a pension. Every year we get pension statements coming through, and there's some stats there that took from Money Week about the average pension size. And again, what's happening compared to 10 years ago? People, especially younger people, now have a pension right from when they start working. That's building up funds in the background. Now, It could be a dangerous world if you start getting into offsetting property versus potential future pension funds. But the fact is you can still learn what people are doing, how much they're paying in every year. You get a pension statement coming in every year. How much have you put in? How much is it growing by? What's it performing like? So if you wanted to start going, okay, future state, what could we do? How can we make our customers' lives better? How can we engage and understand more about them? That's an interesting one. It's up to them to share it. You couldn't just get access to pension fund data, but it's still an interesting area. I had a day off recently. I went to the gym on a Monday. Monday at the gym at about 9:30 is definitely full of the grey pound. There's a lot of fairly wealthy people rocking around who have retired just going to the gym. But the point is, they've got funds and you can understand it. You can learn a lot about them from there. When you start going to the BNPL sector, BNPL is facing a huge amount of regulation this year. It's going to see some significant changes coming in. So how can that help understand? They've got to do proportional affordability checks, start trying to understand more about the customers. They've got to proactively pick up people in financial difficulty. So when you get into the likes of the data from VRS, from Data on Demand, who, we're going to be testing their data this year. I'm saying that for ages. I know Stuart will be upset about that. We are going to. But the point is the data's there. You've got to look at it. You've got to understand it. See, is it any good? How can it help sectors grow? How can you learn from it? And then when you start thinking about other kind of data assets, a big one everybody's talking about now is rental data. It's a huge part of people's affordability each month. Trying to get consistent, good quality rental data is actually surprisingly hard. Credit card payment authorization data. What's in people's baskets? What IP addresses are they buying things from? How does it help confirm their identity? How does it help confirm what they're spending on? Does it make them a better risk? I don't know. It's just more data about them. Open source, social media, that's probably just dangerous, to be honest, but could it help you understand how your customers are behaving? What interests them? What drives them? What motivates them? You want to think about customer experience. You want to think about AI technology. There's a lot of information you can start to consume and use, for example, LLMs or agentic AI to read in to some of this data to learn more about your customers and start to target them. At the moment, there's some relatively basic algorithms out there. I don't know if you guys ever look for holiday. Gone to Google, look for holiday. Basically, for the next 10 days, you'll get absolutely bombarded via Facebook, online. Everyone's, you're looking for holiday, have a holiday. They don't know if you've bought one or not. And the fact you then buy a holiday, and then you keep getting targeted. Again, that's the kind of data you can learn about from there. And then finally, are things like subscription data, your Netflix, gym memberships. Some gym memberships are a minimum 12-month commitment. So again, could that be shared? Could you learn from it? And if so, how predictive is it? Because that's the key thing with all of this. When I started building the team at Equifax, I wanted to make sure that any data we get, we prove its value. It's not just data for the sake of it. I want to know we can do something with it. Because the so what factors, the really important part, is being able to go, yes, this data is useful. It's more predictive. It helps me understand more about my customers. It drives a better experience. And the whole new world of data is very interesting. Yeah, it's great. It's fantastic. There's lots of data out there. We're testing loads of it. We're running programs. It's really good. But also, don't forget the basics. And this is really important. You see, the one thing for all of us that we all have to take into account in this room, for all of us, is all of us are going to die. It's one you can't get away from as a human being. But yet, some companies' processes are absolutely terrible when it comes to dealing with deceased individuals. I don't know why. It just seems something they're very, very tough at. And actually, deceased information, deceased data is really important. When people die, you have bad actors working on the dark web, looking for information, trying to take over accounts, trying to take out loans. I remember years ago working with a utility company. They had an old guy owed them a load of debt. Actually, they didn't at all. The old guy had died about 5 years ago. It looked like one of his children had actually moved into the property and used his name to take out basically a utility account and just not paid for it. But they hadn't looked at the right data. And the thing about that is if you get it wrong, particularly as debt collectors, and just generally in the world out there, when deceased data goes wrong, it hits the press. Okay, when you start chasing an old lady for some money, another story I remember that I keep a clipping of somewhere was there was a chap had died in his car, unfortunately, got taken away. The car got left in the car park until it was eventually recovered. And of course, the car park company chased the lady for the debt, basically, which was clearly not a good thing to do because it hit the press. And that's the thing with deceased, is it's one of those processes, it's so emotive, and when it goes wrong, it causes problems. It's a bad customer experience, and it's bad for you as companies. So what we wanted to do was start looking at, okay, what's available, what's out there? Let's run an exercise to understand if we can actually prove how good the data is that's available. So we actually looked at 3 different sources. We created data samples, and we kind of analyzed it, looking across all of our information. Now, one of those sources we actually effectively put to one side. We kind of excluded it. It's actually a marketing data set. So from a marketing side, it's great. You don't want to be sending marketing data to someone who's died about getting their car serviced. It's just a bad look, okay? And that's slightly different because marketing, it's much looser definitions. Marketing, you can kind of go on, you can fill in forms online and just get yourself opted out, okay? So that's fine. So that's the marketing side. Beyond that, though, confirmed, validated deceased information. That's really key to understand. One, has someone genuinely died that owes money, okay? Or are they just pretending? So that does help, because if they have genuinely died, then really you need to be talking to whoever owns the estate of the individual. That's the route you need to go, not just chasing the person that's left over. So what you want to make sure, when you are starting to look at the deceased information, is that you are using the right sources. So from the analysis we ran, of the two sources we were looking at, one source is stronger than the other. One source has 2.9 million more records than the other. Okay, so when you look across them, they both matched on 5.3. We can then match it based on individual and date of death to pull that groups together, fine. But that was the gap that one of them had, and then the other one had a much smaller gap of 645,000. So if you're not using the right data sources, if you're only using one of them, for example, there is a potential gap in your processes. There could be a risk that someone has genuinely died and you don't know about it because you're not pulling the right information. And I think such an interesting area, deceased, because say it's something that's going to hit everybody. So companies need to have processes that understand this, can validate it, can use data to make the journey as smooth as possible. So when you get notified someone has died, validate it, confirm it, create a process. You know, one of those horror stories that you hear, and I think it might have to do with my mother-in-law when she passed away, somebody was told that she had to write in and tell them. Now, whoever wrote that clearly was having a brain fade day. Somebody wrote a script, and someone read it, which was just utterly ridiculous, okay? They've got to create processes that are good. Use the data to drive those processes because it's out there. So I'll sort of start to finish up now because I've been talking at you for a bit. But just to say, this is kind of the project stuff that my team's working on for this year because I want to prove data. I want to prove its value. I want to look at the BNPL sector, you know, look at it in detail to understand what's going on in that sector, pulling data samples and appending information that we have internally that nobody else has. This is spending behavior information that we can see. Okay, what are people buying? Where are they buying it from? This is our internal data we're running against. And then, of course, one a lot of people are aware of for us is our debt services data. So the team I'm building, we have some analysts, we have a couple of people who will be out for sort of speaking clients, understanding what clients want, to actually build out and validate the data. I'm not just going to go and buy stuff for the hell of it. I'm going to go out there and go, right, what's valuable? What does add a difference? You know, and we are going to test vulnerability data. We are looking across the property market, what else is available. So to me, the value of the data is critical, analytically proving the difference it can make, how it can make a difference. The so what factor, just because you've got data, great, but actually, yeah, what difference is it genuinely going to make to you? What decisions is it going to drive? How is it going to help you? And how, using AI, can you then generate your models to get them better, to make them more predictive, but explainable as well? In an FCA-regulated world, you know, the models that we create, you can't just get an AI black box and just chuck all your data at it. You have to be able to go, here's what we've built, here's why we've built it, here's what it's telling us. And we're using AI to help make better decisions, to help get to that endpoint faster. But I know what it's doing and why. So, as a summary, just sort of where we are at the moment is, as a country, the economy is ticking along. It is on tick over. It's not shrinking disastrously. It's not growing massively. There are some headwinds, particularly this year, that we're going to face. I think, unfortunately, one of those headwinds has got worse as of last Friday. There is some implications now, particularly for inflation starting to flow through a bit more. We're going to see that. Government forecast got reduced again. So I think it's fair to say for the next year, certainly, we're not going to see big swings in the economy. You know, even predictions of 1.6% growth is probably a bit enthusiastic. The government's not in a disastrous position because they have got this surplus. At least they can start to lean into a little bit, which helps them. But yeah, you have got this balance of what's going to go on this year. Meanwhile, consumers just seem to keep ticking along. I've often come to the conclusion that I think a lot of the infrastructure in this country allows the country to keep going along in spite of who's in charge. It doesn't really matter. It keeps going. Consumers keep living. People keep working. They are borrowing. They are borrowing more on credit cards. They are borrowing more on BNPL. and they are borrowing more unsecured loans as well. We are seeing that. So far, we're seeing slight drops in what people are paying off on their credit cards, not massively, but a little bit, but not big upticks in arrears. Unsecured personal loans, that's the only area that there is a little bit of an increase, okay, that we are actually seeing in the uptick in arrears. And that's one of the trends to keep an eye on, alongside the insolvency piece as well, that we have also seen a very slight uptick for the first time to really start to keep an eye on. So that's everything from me. Hope you'll find that useful. If there are any questions, I think, Rich, we can go through a few. Can we have got time for that? Or? Yeah, okay.
Now I'm told it will flick over to slide. Oh, yes, that's it, success.
Yes.
Dennis, I'll probably just read the top ones off to you, but you can probably read them on your own accord, to be fair. A big shout out to Stuart. He's the only person who put his name on the question. It's a bit disappointing for the rest of you.
Well, I gave him a shout out as well. So.
Yeah. So let's do Stuart's first. That'll show you.
There we go, up at the top.
What percentage of BNPL users repay using the interest-free option compared to those who ultimately pay interest on the purchase?
So that's a very good question. That's probably a slightly loaded question, because I suspect Stuart probably knows the answer directly to that. So
do you know the answer?
It is a good question. So it's not something that we can necessarily see. So when we're looking at the data, we're looking at open banking transaction data, and we are looking particularly at the Pay in 3. So we're looking across your Klarnas, your ClearPays, we're looking across PayPal Pay in 3. Now, a lot of these companies have other versions of borrowing as well. You've got your likes of your Argoses as well, who do the older version. Because again, within BNPL, don't forget, you have different types. That's the key thing. So BNPL itself is not a new thing. Anybody with an Argos card gets offered 9 months and 6 months interest-free. Okay, and on those, again, the returns we see are pretty good. If people have a 6-month plan, they do tend to pay it down. I don't know exact percentages, but it's generally the turnover is pretty good of how people do behave around those. Specifically, sort of type 1 BNPLs is where you're into a world of it's 3 months, interest-free. Another definition, which is really interesting, is it actually doesn't have a credit limit. That's one of the official terms for BNPL. So that's when you get to the till, you pay for it, and you then buy your shoes and off you go. The reason the world is also interesting is because the other thing we can see in the data is very few people just get one account and call it a day. They get 2 or 3 or 4 or 5 or 20, and that does happen. And what we'll generally see within that, there will be a percentage of people that do miss payments and then get hit with the interest. Okay, now, when you talk to the BNPL companies, there's still a lot of them in that growth mode. We don't have arrears. It doesn't happen. It's fine. Nah, not at all. Actually, yeah, the reality is yes, they do. And when you look at some of their models, generally speaking, you're normally into a world of 10 to 15%. So you can extrapolate that. You can go, right, if people are paying interest, you're going, I suspect, to be into a world of around about 10 to 20%. That's kind of the world it will probably hit, I think. So hopefully, Stuart, that's fair enough. I am going to test your data. I promise we would. That is going to happen.
You heard it here first. And everyone else is a witness now. Excellent. Thank you, Anonymous, for your questions. Will CRAs eventually have a full view of our lives through apps, social media data? Will that impact credit scores?
Yeah, so that's a really good question. So there's 2 parts in that, and the first one is one of my sort of soapboxes, my high horses that I get on. The credit scores questions I think is always fascinating. Okay, anyone's talked to me about this will know my view on this. We're not America. We don't have a FICO or a Vantage score. In the UK, all the bureaus build their own scores, and all the scores are different. Not like lenders build their own scores. So when you talk about impacting scores, that's very emotive. Okay, so we're actually doing some work with the BNPL companies at the moment to think about potential implications. Now, the reality is it going to impact credit scores? That's up to us. There are scores. We build them. We look at the data. We figure out what's predictive. We build the attributes that feed into the scores, and we work with our clients to do that. So would it impact it? If the data was useful, yes, potentially. But also it's feeding into policy rules. Don't forget, when you apply for a loan, it's policy rules and scores that come into play. And it's using both bits of data that helps lending decisions. So possibly. In terms of getting access to the data, would people allow us to do it? Okay, that's the interesting part, because really you're into a world of data democratization again there, okay? This is not about us being able to go and hoover up all this information unless there is some kind of legitimate interest for us to look at your Facebook account, which really there isn't, okay? So you do get into a world, which was kind of the drive score piece around going, right, if you guys want to share it, can it make a difference? And that's a world we're starting to look at, we are trying to understand, which is, okay, how predictive is this data, or is it just noise? Because it's kind of stuff we would quite like. Now, as an example, Equifax has just launched an app that you can access your credit profile and you can go and have a look at it, etc. So again?
That's convenient.
It is, isn't it? Yeah, it's quite handy. We're just in the process of launching it. But the data that sits within it, we can't just hoover it up and use it, because again, individuals own that data. Will they share it with us? Okay, they're pulling a lot of data from us, but there's other bits they can put into it. Will they share it with us? No, probably not. So I think ultimately with that one, I think the first question is, will you have a full view of our live through apps? No, I don't think we will, because I don't think most consumers will give access to that, okay? Aspirationally, could be useful, and it would only be good if we tested it and proved it was actually good. Does social media genuinely make a difference to making a decision about somebody if you want to lend them some more money? Okay, that's sort of where I think that's what comes into play. Would it impact scores? That would be up to us to test it. If we got hold of enough of it and it was predictive, yes, possibly.
I think the interesting thing about that question for me is you look at things like open banking that came out the last couple of years, and I don't think the name open banking fills the consumers with a whole lot of joy. And I think when you start talking about social media, it's probably a similar challenges. You start getting a few people using it and it impacts their score in a positive way, perhaps.
Yeah.
You might see more people taking that as a traction process, right?
Yeah, the sort of big one everyone talks about, share your rental data, it'll impact your score. Yeah, that's not proven, okay? Yes, it shows what's happening on in affordability, and it's all about the value exchange. So you as individuals will only share your data when you think you can get something out of it, which is why when we look at the world of debt collection, open banking hasn't been a huge seller, because people kind of go, hang about, you look at my bank account, see if I can pay you. I'm not sure about that. That's the reality of what people are looking at. They control the data. Okay, so the value exchange is absolutely critical to the point is if someone's going to share data with you, and that's why we're trying to drive the rental data particularly, because it can be very useful, it can make an impact. But the flip side of it is there are a lot of people that live in rental properties that will do for a long period of time, particularly social rental. And at the moment, they're kind of relatively invisible when it comes to affordability. You can't see a big chunk of what goes out each month from an affordability side. And yeah, they might declare an application, but not say the full amount. So if they're not sharing the data, that's kind of the benefit they can have if they're not that bothered about what if they do want a mortgage or not, or if they're going to get other loans in the future. It doesn't sort of make a huge impact to them. So,
cool. And then probably got to ask someone with 7 thumbs up, haven't we? Do you have any insights into commercial insolvency trends?
Yeah, so commercial insolvency trends are actually relatively flat for the course of this year. So when you looked at it, they were about 23,500, if I remember rightly, for the course of last year, which was very, very similar to 2024. Okay, they've both come down since 2023. So 2023 there was a bit of a spike of commercial insolvencies. 2024, 2025 have both stayed relatively flat on that front. Now, some of it, particularly post-COVID, the reason 23 was quite high is because there was a lot of what you might call sort of shell corporations that started to close as well. People that had taken out COVID, bounce-back loans, etc., were starting to sort of close down. At the moment, I think the one interesting change for last year was there was more forced bankruptcies. So obviously when you get as a company that goes to bankruptcy, that can either go voluntary or forced, there was more forced. And that was the one thing that we did see. But otherwise, the trends are relatively flat at the moment, which is, again, encouraging.
Yeah, of course. And then there's quite a few questions on here. Maybe we'll ask one more. So you say that the employment rate is static. Is the average wage increasing with inflation or remaining unchanged as well? Yeah,
that's actually a relatively, I'd call, open source question. That's not our data. That's data which is readily available. And again, if you kind of look at the stats that are out there in the market, then wage growth has just been softening. Okay, so actually you had that point. Inflation post the war in Ukraine absolutely took off. Wage growth was behind it for a long period of time. And then sort of during, I'm pretty sure it was 2024, and into 25, you started to see wage growth starting to consistently outgrow inflation. And that has been the case, and it is really still the case. So even though the market itself has actually loosened and weakened a bit, people's wage growth is still keeping up with inflation, having actually been above it for a longer period of time. Unfortunately, the bit that does kind of slightly counteract it is the general cost of living. You know, the whole piece now, when you look at how much energy is costing you, council tax has been going up. Generally, if you look at most rises for companies, fees, charges, you're often looking at 5-6%, and that's what tends to eat into that kind of real terms income. Is you tend to find, it's been going up with inflation, but other stuff's been increasing at above it, and that's what's costing people more money, so hence they feel a bit poorer.
Perfect. Dennis, that was really informative. We've got quite a few other questions coming through. Maybe throw these over to you and email them out, if that's all right?
Of course. Yeah, no problem at all.
Thank you very much, Dennis. Well done, mate. Thank you very much. Appreciate it.